Welcome to the deep dive. Today we're really getting into the weeds on oil and natural gas. What's happening now is coming up soon.
Yeah, and we're leaning heavily on a pretty insightful interview with Eric Nuttall, the portfolio manager.
Right, plus insights from OG Oil, Gas, and Energy News and Rig Zone. The idea is to cut through that daily market chatter.
Exactly. Get to the fundamental shifts, give you a clear picture of what actually matters right now.
So first up, this whole tension between market sentiment and, well, the actual facts on the ground for oil.
Uh-huh. Nuttall really highlights this. Sentiment's challenged, no doubt. People are spooked about tariffs, worried about demand.
Tariffs are definitely front and center. It feels like, every day there's something new, and that shakes confidence.
It really does. And it's not just a feeling. The worry is these tariffs slow down global GDP.
Which hits oil demand directly.
Precisely. Nuttall uses this rule of thumb: every 0.1% GDP slowdown. That's like 100,000 barrels per day, less demand growth, potentially.
Okay, and we're seeing forecasts cut because of this.
Yeah, big time. Demand forecasts for the year, they've been slashed by about 500,000 barrels a day. We're now looking at maybe 700,000, 800,000 barrels per day growth, much lower than expected.
Wow, 500,000 barrels, that's significant. So the demand side looks a bit shaky. What about supply? Anything pushing back?
Oh, absolutely. And this is, I think, really crucial. Nuttall points to a major slowdown in U.S. shale growth. Like the slowest pace since shale really kicked off back in 2024, if you ignore the whole COVID weirdness.
Slowest pace. He's not expecting growth to just stall.
He even suggests we might actually see U.S. shale production decline this year. A decline. That's based on his firm's analysis.
That is a huge shift. Shale's been the engine for years. But then there's OPEC plus, right? What are they doing?
Good point. The OPEC plus countries with those voluntary cuts, they're actually speeding up bringing that oil back online.
Oh, okay. So shale growth slows, but more OPEC oil comes in.
Kind of a wash, as Nuttall puts it. The overall supply change isn't as dramatic as you might think because those two things are sort of canceling each other out right now.
So weaker demand, slower shale, more OPEC oil. How does that shake out for prices? What balances this?
Well, the market has to soak up those extra OPEC barrels, right? While non-OPEC supply growth is slowing down, Nuttall's latest thinking, the price needed to make that work is probably somewhere around $60 a barrel now, lower than previous estimates.
$60. Okay. And this feeds into that idea you mentioned, the twilight of U.S. shale. Sounds dramatic.
Right.
Diamondback Energy is saying similar things.
Yeah, exactly. It's this growing idea. And hearing it from a big player like Diamondback really adds weight. It basically means the party's winding down for rapid shale growth.
Why now? What's the core reason?
They're running out of the best spots to drill. That really high-quality Tier 1 inventory, it's getting scarce.
Ah, so they have to drill in less good areas.
Precisely. They're moving to what they call Tier 2, Tier 3 acreage. It's less productive, often gassier, just doesn't give you as much oil.
And all those drilling efficiency tricks they've learned, that's not enough anymore.
It seems not. Nuttall argues, and Diamondback seems to agree, that efficiency gains just can't fully make up for drilling worse rock. Geology is geology.
Makes sense. Did Diamondback give a price point for when they might grow again?
They did. They suggested needing oil prices up in the $65, maybe $70 range, plus a better economic outlook before they'd even think about ramping up growth.
So if a top company like Diamondback is pulling back, what about the smaller guys?
It definitely signals a wider impact. Those smaller producers, the Tier 2 and 3 guys, they're often the ones providing that marginal barrel. So if Diamondback needs 65, 70 del, those guys probably need at least that, maybe more.
So whether shale plateaus or actually declines depends on price, but either way, we're losing that easy source of new supply.
That's the key takeaway. We're losing that marginal source of supply growth that the world has kind of relied on.
Which means back to relying more on OPEC and those big long-term projects.
That seems to be the direction, which makes all that drill baby drill talk you hear sometimes. Old Nuttall calls it laughable.
Laughable? Why?
Because the companies themselves, look at the Dallas Fed survey. They're saying they need oil around $64, $65 just to operate sustainably.
Yeah.
Forget massive growth. The economics just aren't there at lower prices.
So a real gap between political rhetoric and business reality. That can't be good for sentiment either.
No, it probably muddies the waters. And that all kind of touches on this concern. When people move from industry into government, do they sometimes have to toe a political line? Maybe promote policies they don't fully buy into themselves? He even mentioned some Department of Energy meme about it.
Interesting point. Okay, let's shift gears a bit geographically.
Yeah.
North to Canada, New Prime Minister Mark Carney. What's the vibe for energy up there?
Yeah, Carney adds a layer of uncertainty, for sure. As Nuttall points out, campaign talk isn't always policy reality.
So wait and see.
Pretty much. The big tell will be who he appoints to his cabinet. Will it be more of the same resource suppression we've seen, or something different?
But Carney himself has a history that makes the energy sector a bit nervous, doesn't he? His book comments on climate.
Right. His book Values, talking about stranded assets, his alignment with figures like Greta Thunberg, it definitely creates some apprehension, especially with laws like Bill C-69 already making it tough to build pipelines and export.
So that whole Canada as an energy superpower idea faces some real roadblocks.
It seems challenging under the current setup. If you can't get the product to market easily, it's hard to be a superpower.
But there's a potential silver lining for investors.
Potentially. Nuttall raises this interesting point.
Sure.
If companies can't grow production much because of infrastructure limits, what do they do with their cash? Maybe more goes back to shareholders via buybacks and dividends, higher free cash flow yield, even without growth.
Interesting dynamic. Okay, let's swing back to OPEC plus PAN. They decided to boost output more than expected in June. What's behind that?
Yeah, they're basically accelerating the return of those voluntary cuts, tripling the planned increase for June.
Is this some grand bargain with the U.S. or something?
Nuttall doesn't think so. His take is it's more about internal discipline, or lack thereof. Specifically, Kazakhstan hasn't really been sticking to its production agreement.
Ah, so it's internal OPEC plus politics, not playing by the rules.
Seems like it. Saudi Arabia's been compliant, and they seem to be pushing others, especially Kazakhstan, to get in line. Kazakhstan keeps saying they will, but the numbers haven't really shown it.
So this faster production increase, is it a warning shot?
Could be interpreted that way. Nuttall suggests the strategy might be keep bringing barrels back, maybe push prices down towards that $60 level we talked about,
Why? To hurt non-compliant members.
and potentially to curb U.S. shale growth at the same time. Hitting two birds with one stone, maybe. A bit punitive towards those not following the plan.
Okay, fascinating. Let's circle back to demand uncertainty. You mentioned it earlier. Sounds like it's a huge factor right now.
It really is. Nuttall draws a stark contrast here. Oil demand, super uncertain, recession fears, tariff impacts. It's cloudy. Natural gas, though, he sees a clearer path.
And that uncertainty is why the portfolio is shifting heavily towards gas.
Exactly. With oil, the supply side is actually getting a bit clearer. Companies are announcing capex cuts, telling us they're slowing down. But oil demand, that's the big wild card.
So until you're sure demand won't crater and inventories won't spike, oil feels riskier.
That's the idea. There's less conviction there right now. What's that price that really puts the brakes on shale? Nuttall thinks it's probably in the $50, $60 range. Maybe $60 is the balancing point if the economy doesn't slow down sharply.
Okay, so with oil being tricky, natural gas looks more appealing. Why the higher conviction there?
Well, the natural gas thesis, as Nuttall lays it out, it's just less tied to all those big global worries, recessions, peak oil demand debates, OPEC drama, geopolitics.
What's driving it then?
It's really a structural demand story, primarily U.S. LNG exports, liquefied natural gas. That demand is set to boom, projected to hit like 26 to 28 BCF a day, billion cubic feet by the end of the decade. Plus, Canada's about to start exporting LNG too.
And that helps Canadian gas prices specifically.
Absolutely. That big discount Canadian gas usually trades at compared to the U.S. That should narrow significantly as they start exporting LNG, which means more free cash flow for Canadian gas producers.
Even at current gas prices.
Yeah, even with gas around, say, $4 or $5, these companies are showing really attractive free cash flow yields. Think 15% to 24% range. That's pretty compelling.
And besides LNG, any other demand drivers?
Yeah, the other big one is AI data centers. They need a ton of power, and natural gas is often the source. So you have LNG build-out, AI demand, which is a strong structural picture. Plus, Nuttall thinks the actual cost to get new gas production online is probably closer to $5 than $4 anyway.
Suggesting prices have room to move up or at least a firm floor. So, reflecting this conviction, what does the portfolio look like now? How heavy is the gas weighting?
It's the highest it's ever been, actually. Around 70% in natural gas right now.
70%. Wow. And the rest?
About 30% in oil service stocks. He considers them pretty much uninvestable at the moment because of those looming capex cuts from producers.
And the target price for gas.
The view is $5 natural gas for 2026.
Have you looked at diversifying elsewhere? Coal, renewables, uranium.
They apparently dipped a toe into coal previously, but exited that. The view seems to be that yes, all energy demand will likely grow, including alternatives, but natural gas, that's seen as having mega growth. It's moving beyond just being a bridge fuel.
To being the fuel.
Sort of. Maybe a foundational fuel, anyway. Oil demand growth is expected to moderate, maybe 800,000 to a million barrels a day. Uranium. Strong green argument, sure, but the project timelines are really long, and the free cash flow profile isn't as attractive right now compared to oil and gas.
So the focus stays squarely on oil and gas companies with certain traits.
Yeah, the sweet spot seems to be companies with decades of inventory, solid balance sheets, low debt, cash on hand, modest growth plans, and a real commitment to giving cash back to shareholders. Dividends, buybacks.
Okay, let's try and pull this all together. If you had to summarize the key takeaways on oil and gas right now.
Okay, medium and long term for oil. Still looks pretty bullish, fundamentally, but short term. Demand is the big question mark. The market needs to rebalance based on what demand actually does and how OPEC Plus reacts. Long-term scarcity for oil still seems likely.
But near term.
Near-term, natural gas just looks like the better bet. It's a simpler story, higher conviction, less tied to those big macro swings.
Any final words of caution or optimism?
Just that it's wise to be cautious about extreme views. Either way, in energy, things can change fast. But overall, the outlook for energy stocks, short, medium, long term, still looks pretty bullish from this perspective.
This has been incredibly insightful, really drilling down into the complex dance between oil and gas right now. It's clear, like you said, oil demand is the big uncertainty, while natural gas has this more solid, growth-driven story unfolding. Plus, the shale shift and OPEC plus moves are critical pieces.
Absolutely. And maybe the thing to leave people thinking about is this. Setting aside the short-term noise, how might these longer trends, the rise of LNG, the limits on shale, fundamentally change the whole energy map over the next 10 years? It really forces you to consider, just how central natural gas might become as we move forward. It's something to mull over.